It's now time to talk a little bit of economics. When we do that, we talk to JP Gervais, Chief Economist with Farm Credit Canada. Hey, JP, how you doing on this Friday?
Hey, I'm doing very well. What about yourself?
I'm doing great. I'm doing probably better than Jerome Powell, the Federal Reserve Chair. He's had quite the week. He basically they cut rates by 25 points. Now he's got basically a split from inside his circles on what they do next, and he's still getting hammered by the president on Twitter. Where does he go from here?
Yeah, not just quite the week, quite the last few months, I would say. No, it's not a role that I actually would like to be in right now, because it's almost a no-win situation right now, because you cutting rates in light of some data that, it can be seen as a little bit soft, but you're cutting mostly as insurance against future shocks, right? So where do you go from now? If you don't do anything, then you're going to be pointed out as being said, hey, you should have done more or taken more insurance out of against what could happen in 2020 in terms of the slowdown. And if you do something else, and it turns out that you've been too aggressive in terms of cutting rates, because the economy was nowhere near the cliff that everybody's talking about, and that could create a little bit of trouble down the road in terms of inflation. So it's a tough spot to be in for sure. I'm actually quite surprised, given the split, as you said, among the team there or the council. I'm actually quite surprised to see where the marketplace is actually putting the probabilities of seeing a rate cut. You're almost at 45%. You were yesterday. I haven't looked today, but you were yesterday close to 45% probability of seeing another rate cut in October from the Fed. That to me is really high. And then way over 50% before the end of the year. So despite the split, as you said, the median points out that no cut till the end of the year, but you do have quite a bit of dissidence in terms of other governors that think that they should be cutting. The markets seem to be putting a little bit more weight towards that, and I don't know if it's the Trump influence or President Trump's influence in terms of pressure that he can put on the Federal Reserve, or what exactly is behind the marketplace, but markets seem to think that there's going to be another rate cut.
Okay, I understand pretty clearly what happens if you raise rates too fast. You can really just grind the economy to a halt. What's the risk of cutting rates too aggressively? What happens in that situation?
I think the main risk is to see inflation pick up, and those that promote more aggressive rate cuts are basically saying that they absolutely don't believe that the economy is a capacity. Because once you hit this capacity, once you hit the point where everybody's employed, businesses have such a hard time to recruit that they're paying higher and higher and higher wages. And remember, as you and I discussed on this show, for a number of times, we've waited a long time to see wages go up, but we're there yet. We're there now, actually, just with both in Canada and the U.S. And so as you're, at one point you're hitting that capacity constraint. There's just not a whole lot of capital laying around for businesses to invest in more. Now there's just, bringing in more workers and then bringing higher wages, more spending, and then you see inflation run up, and that's when you can get in front of yourself, and then you're going to be playing catch up, and if it's just it's quick enough to act, and runs out of control. And too much inflation is not a good thing, and not enough inflation is also not a good thing. It's a very delicate balance to reach, for sure.
So what does Canada do next? Because we've been holding pat. We've been holding pat. We've been just we'll see how this all works out. U.S. has cut a couple times since Canada has not, since Canada's last cut. So what's the Bank of Canada going to do?
Yeah, a very neutral stance, and I'm going to go back to those probabilities, right? So for those that wonder, what am I talking about when I say a probability for the marketplace? Well, you're looking at interest rates and the different maturities and terms for different products out there, and then you can take all of that in, and then you can infer what does the market think in terms of future rate movements, right? So you're looking at swaps and all those type of things, and that probability of seeing a rate cut in Canada right now is about 12% for October. So that's really low. It used to be not too long ago in that 30, 35, even I believe we exceeded 40 at one point, 40%. But and the probability of seeing a rate cut before the end of the year is now at 18%. So it's very low. We were at one point over 50% in terms of the probability of seeing a rate cut in Canada. So the market seems to think that, yeah, we listened to what the Bank of Canada said last time around, and they have a neutral stance. And what we're seeing in the data, there's some mixed data for sure, but overall inflation's under 2%. Wages keep going up, so you got to be careful about consumers spending more and more, so that you have a little bit more inflation. Exports have rebounded quite a bit in the second quarter. Business investment is perhaps the only thing that's kind of down significantly, but other than that, it's things are not necessarily bad, and so we sort of believe that the neutral stance of the Bank of Canada is going to hold for the rest of the year. And so, yeah, you see what the probabilities are. So, having said all of that, I think the one thing is with such a, I would say, higher than expected probability of seeing a rate cut in the U.S. and a lower than expected probability of seeing a rate cut in Canada, I would think that this is going to lead to a little bit of softness in the Canadian dollar over the next couple of months. We're a little bit over 75. I haven't looked today again, but I would expect that to soften it a little bit.
Well, yeah, right now we're floating around 75 too. So, kind of, and really locked in a bit of a range here where clearly the market is unclear on which direction to hit. If I remember back to the beginning of the year, one of your forecast for the year was on the Canadian dollar, and I think you said 75. So, boy, a few months to go here, JP, but you're looking good.
We're looking good. I'm not going to talk about the times that we haven't looked good, but because there are a few of them for sure. But yeah, at 75, and I would say that just given the weight of the market towards a hike in the U.S. and no move in Canada, I would suspect that we're going to finish perhaps slightly under 75 at the end of the year, but I don't expect, unless some major shock in the world economy. So, thinking of a combination of the China-U.S. tensions that just move in the wrong direction, and without the idea that this can be resolved in any point before the end of the year. Think Brexit without a deal. Think more news coming out of the Middle East and unsettling news coming out of the Middle East. And so, but bearing any of that, I don't see the Canadian dollar drop a lot. Lower than under that $75 range. If anything were to happen along the lines of major economic shocks, then perhaps this is where you could see the Canadian dollar drop a little bit further. But other than that, I still expect it to finish around 75 for the year.
Well, there's a lot of concern about what's going on in Europe economically, specifically Germany is one example. Canada, is it fair to say that Canada is kind of weathering so far this global concern about economy slowing down? Our GDP is not exactly a raging ball of fire, but it seems like we're kind of skating through so far okay.
Yeah, not too bad for an economy that's quite export dependent, I would say, right? So you're talking about Europe. I mean, if you got negative rates in Germany, negative rates in France, Italy has reached an all-time low in terms of yields, not yet negative, but, you're getting close. European Central Bank is going to unveil new stimulus, or is expected to unveil a new stimulus package that will include a rate cut plus some of the stuff. So, everywhere else you're going, there is an easing of monetary conditions, and in Canada we seem to be weathering the storm, which is a little surprising given that we're so export dependent, right? So let's not just there's nowhere to hide the fact that we're quite export dependent. So exports, as long as they rebounded in the second half, if you think of a little bit more of a, it's not long term, but certainly instead of just looking at the last 3 months, you're looking at the first 6 months of 2019, and even into July and August. I mean, things are okay. I mean, they're holding up pretty well. It's one of the surprises, actually, if you're looking at, we just got retail sales that got out, August retail sales that were released today, and they're flat. It's a bit surprising, actually, given that consumers have been doing so well, in terms of wages, in terms of overall disposable income, in terms of borrowing costs that have come down, even though there hasn't been a rate cut by the Bank of Canada. We've seen interest expenses come down. So the fact that sales are flat is kind of a question mark. But you really have to dig like this and then just find those spots where you think, maybe there's a question around there. Like why is this the case? But other than that, we're doing well.
From an agricultural standpoint, though, there is definitely some concern here from a profitability standpoint on the horizon. Commodity prices have dipped. There has been some strong trade on some of the crops like wheat. Of course, farmers concerned that, hey, volumes are great, price not so much. That has to drag things down a little bit, doesn't it?
Absolutely. I mean, there's no denying that. I mean, if you look at what 2018 was like, there was quite a bit of noise around the fact that net income in the farm sector came down, and I would argue that I would say almost 90% of that decline in net income was actually on the expense side, because if gross revenues was roughly flat. Now I think we're seeing quite the opposite in some ways in 2019, where I think gross revenue is going to be pressured, right? If you're looking at some of the yields that were put forward by Ag Canada lately, and convert those yields and that production into revenues using some of the commodity prices that we've seen for the first 6, 7, 8 months of the year, you could be looking at $1.5 billion less gross income on the crop side, which would be significantly different than in 2018. So that would be, some pressure on gross income that were not necessarily expected at the beginning of the year. Now, having said that, I do believe that some of those assumptions are going to be revised upward in terms of production. We'll see. We'll see what kind of quality issues are there. But there could be a little bit of pressure on the top line of producers and looking at gross revenues. Good thing is that we're not going to have any type of similar appreciation or upward pressure on expenses. But having said that, that could still pressure net income. I don't expect a big rebound in net income in 2019. So there's still quite a bit of pressure there for producers.
Hey, JP, thanks a lot. I really appreciate you joining us here.
It's always a pleasure. Thanks, Shaun.